Welcome back to the Deep Dive. Our mission here is simple. We take a mountain of financial data, like a major earnings call, and we just distill it down to the insights that truly matter for your understanding. Today, we are digging into Viasat, that's ticker VSS, and their Q2 fiscal year 2026 earnings update.
And this one was really complex. There's a fascinating tension at play here.
A huge tension. On one hand, Viasat delivered this impressive story, anchored by strong operational metrics, great cash generation in the first half.
But then you have the market reaction, which was, well, it was undeniably negative.
Exactly. It signals that investors were way more concerned with what's coming down the pike, capital demands, execution timing, than with what just happened.
And that tension, that's really the core of our deep dive today. We need to unpack that duality. We'll get into management's long-term plan for capital efficiency. We'll analyze the high-stakes updates on the Viasat-3 program.
Which is the biggest overhang on the stock, for sure.
No question. And we'll connect all of that to the growth drivers they're banking on, especially in defense and aviation. We're really explaining why the stock dropped despite some pretty big wins.
Okay, let's just dive right into that. Let's start with a snapshot of the results because the picture was so mixed.
It really was.
Starting with the headline numbers, GAAP earnings per share came in at 9 cents. And that was a clear, significant beat. Consensus was calling for a loss, somewhere between 6 and 11 cents.
The huge beat on EPS, but the top line was a bit softer.
Right.
Revenue landed at $1.14 billion.
A slight miss versus the $1.15 billion expected.
Right. It's still 2% year-over-year growth, but, a miss is a miss. But if you want to understand management's story, you have to look at their preferred metrics.
The ones that speak to operating stability.
Exactly. The one they were laser focused on was adjusted EBITDA. That came in strong at $385 million, up 3% year-over-year.
And that drives a really healthy 34% margin.
It does. And they lean on that metric because, it gives you a much cleaner look at their core operating profitability. It strips out all the massive non-cash costs from debt and, from their enormous satellite assets.
And their story on cash flow was just as bullish, wasn't it?
Absolutely. So operating cash flow jumped 18% year-over-year to $282 million. And here's where it gets really interesting for the long-term story. Free cash flow was positive. $69 million for the quarter.
Which is a huge milestone.
This is a massive milestone. This was the third consecutive quarter of positive SCF on a trailing 12-month basis. For a company that has been so capital intensive for so long, achieving that is a huge step.
It really is. And yet, despite the FCF wins, the EPS beat, the strong EBITDA, the stock fell almost 4.5% after hours.
Mm-hmm.
It's just a textbook case of investors saying, we don't care about the rearview mirror, we care about the road ahead.
Precisely. The market is asking, what's the cost of this growth? And when does the investment finally turn into predictable cash? But before we get to that CapEx crunch, let's ground ourselves on the operational wins.
Agreed. Let's look at the foundation. They're certainly stacking up future business. Total awards reach $1.5 billion. That's up a solid 17% year over year.
And that flows directly into their backlog. Total backlog hit a record high of $3.9 billion. That's an increase of $140 million just in the quarter. That kind of visibility, it provides critical stability.
Right. So digging into the segments, communication services revenue was only up 1% overall. But inside that number, aviation is the clear bright spot.
Aviation is absolutely carrying that segment. Revenue there grew a strong 15%, and commercial aircraft and service were up 11%.
So they're getting those installs done.
They are. And even though their aircraft backlog declined a bit to about 4,470, Q2 was actually their strongest quarter for installs since way back in Q4 of 24. It shows that their multi-orbit strategy is really gaining traction.
Okay, now over to the defense side. DAT revenue grew 3%. Which is steady, but the forward-looking signals looked a lot stronger.
Much stronger. The book-to-bill for that segment was a robust 1.5x, and the strength is really concentrated in a few high-margin areas.
Like what?
Specifically, InfoSec and cyber. Product revenues in their high-assurance encryption products jumped 14%, and this growth is tied to these, powerful, unstoppable secular trends.
Which drivers are most relevant here?
The biggest one is just the geopolitical shift. The increasing reliance on space-based assets for national security, it's creating this massive demand for highly resilient communication systems. And the other key driver is the push for quantum-resistant cryptography. Management called it a big refresh in secure systems.
Is Viasat truly ahead of the curve here, or is this just something every defense contractor is doing? I mean, how proprietary is this big refresh?
That's a fair question. Look, the need for it is universal, but Viasat's advantage is their established franchise. They already have the high assurance certifications from government clients.
So they can capture the demand immediately.
As soon as the products roll off the line, it's an advantage of incumbency and trust, and you just can't buy that in the defense sector.
Okay, that sets the stage for some really strong operational momentum. But, like we said, none of that was enough. So let's pivot to the biggest single reason the stock dropped, the Viasat-3 program.
This is the elephant in the room. The timing on Viasat-3 Flight 2, their next big satellite, it was highly problematic.
Problematic is one way to put it.
The launch attempt was scrubbed the night before the earnings call, an issue with the Atlas booster. Management immediately stressed that the launch is still imminent, but that delay, even a minor one, introduced uncertainty that the market just hates.
Why did that timing matter so much?
It's all about capacity. Each new Viasat-3 satellite is designed to have more bandwidth than their entire existing fleet combined. Yeah. And that capacity is crucial for the areas where they're struggling. Specifically, fixed broadband. Their fixed services revenue was down a worrying 16%, and they're down to only 150,000 subscribers. They desperately need that new capacity.
So the capacity is delayed, the revenue is delayed, but the spending isn't. So what does this mean for the full year guidance?
The guidance is cautious. Revenue up only low single digits, adjusted EBITDA guided to be flattish. But the real source of the market's anxiety is the CapEx commitment. It's still extraordinarily high at about $1.2 billion for FY26.
Wow, $1.2 billion. That's a massive number. Can you break that down for us?
Sure. It's a few moving parts. So about $500 million is just standard maintenance. Another $100 million is what they call success-based capital, so they only spend that if they win specific contracts.
Okay.
Then you have the Viasat-3 costs, $250 million to complete the program, and finally about $200 million in capitalized interest.
And that capitalized interest, that's not an immediate cash drain, right? It's more of an accounting thing.
Correct. But that entire $1.2 billion figure, it just screams capital intensity to the market.
And here's the key financial warning that really triggered the sell-off.
Exactly. Management expects to spend $200 million of that Viasat-3 completion CapEx in the second half of the year. And because of that heavy, lumpy cash outlay, they guided for negative free cash flow in the second half of FY26.
There it is. That's the friction point. Investors hate near-term cash burn, especially right after you've celebrated 3/4 of positive FCF.
It just creates enormous risk sensitivity. It makes them look slow compared to the LEO rivals like Starlink.
Yeah.
And that's why the market punished the stock so severely for a delay and a cash warning.
But there's a hook here for the long term, right?
A very compelling one. Management reiterated their critical path to positive full-year FCF in fiscal year 2027, once this final CapEx burden is gone. Achieving that inflection point is the fuel they need to finally deleverage.
And they're taking action on their debt now. They're going to repay their remaining $300 million under that original Inmarsat term loan,
which is expected to save them about $23 million in cash interest annually. And they got some help funding that. They got a $420 million lump sum payment post-quarter end from that Legato EchoStar deal, so they have the liquidity.
And there was one more headwind. The U.S. government shutdown.
Right, a near-term drag.
Right.
Could delay up to $100 million in data awards and maybe hit EBITDA by $20 million in Q3. They don't see a full year impact, but still.
Which leads us perfectly into the broader investor context, the big strategic storylines. And the first one is activism. You have this activist-driven portfolio review. They're actively evaluating, separating the government and commercial businesses.
And management is kind of caught in the middle. They're weighing the benefits of vertical integration and what they call dual-use synergy against a potential spinoff.
Can you just quickly clarify what dual-use synergy means for them practically?
Sure. Essentially, the tech they develop for the government, highly secure, resilient stuff, can be immediately applied or licensed to their high-value commercial customers, like airlines. The government basically pays for the R&D that they then sell commercially.
And they made a point to say that integration and separation are not mutually exclusive.
Which sounds like a management team trying to appease an activist while holding on to their strategy. It leaves the door open for some complex changes.
So what's the second big strategic storyline?
It's all about capital efficiency and how they compete with LEO. They're leveraging their global MSS spectrum position, which is a rare, valuable asset, and they're trying to monetize it without taking on all the risk.
Like that Equitas joint venture with Space 42.
Exactly. Create shared infrastructure for regional operators so everyone's capital intensity comes down. It's a huge differentiator from SpaceX, who has to build everything themselves.
And they're innovating on the tech side, too, with that new HaloNet architecture.
Right. Blending space and terrestrial networks for specialized services like LEO to GEO relay for Earth observation data. It's their answer to providing integrated services, no matter whose orbit the assets are in.
That's a crucial piece of the puzzle. Okay, before we get to the trade idea, let's quickly list the 4 core catalysts for you, the listener, to track.
4 major things. 1, the successful launch and capacity deployment of Viasat-3 Flight 2. 2, continued multi-orbit adoption, especially in maritime and aviation. 3, the outcome of that activist portfolio review. And 4, hitting that all-important full-year FCF inflection point in FY27.
And now let's dive into our final segment. And remember, this is analysis, not investment advice. It's just a way to frame the risk and reward we've been talking about.
Okay, let's put on the hedge fund analyst hat. The thesis here is pretty straightforward. The market's reaction is entirely focused on near-term cash burn and that delayed satellite. So this has created a temporary event-driven opportunity based on execution risk.
So what's the play, given that high execution risk?
Well, since the single greatest uncertainty is that Flight 2 launch, the outrageous but plausible trade is a directional pivot. Short VS until the Viasat-3 Flight 2 satellite is successfully launched, and then immediately flip that position to a long hold.
That's a bold switch, all centered on a single event. What's the rationale for flipping long once the bird is in the sky?
Because the scrubbed launch is what's prolonging all the uncertainty. It's amplifying the perceived CapEx risk, a successful launch that removes the single greatest operational overhang, period. That event makes the FY27 FCF inflection a much, much higher probability event. So the flip is about moving from pricing in execution failure to pricing in the tremendous operational leverage that $1.2 billion in CapEx is finally going to unlock.
It's a classic trade. A bet on execution risk now, transitioning to a bet on operational leverage later.
You got it.
That is a fantastic analysis of a really complex quarter.
To recap, Viasat showed strong operational performance in aviation and defense, great cash generation in the first half. But the high final CapEx load and the launch delay forced them to guide for negative FCF in the second half. And the bull case rests entirely on executing toward positive FCF in FY27.
And here's a final provocative thought for you to consider. The competition for spectrum and direct-to-device is accelerating fiercely. Does Viasat's multi-orbit, capital-efficient, shared infrastructure approach offer a superior competitive advantage against rivals like Starlink? Or will their debt and the slow CapEx wind-down erode that lead they gained with Inmarsat?
That really is the central strategic question in the entire space communications sector right now.
Indeed. Thank you for joining us for this deep dive. We hope this gives you a comprehensive understanding of the path ahead for Viasat. Until next time.